Your retirement account owns a piece of SpaceX and OpenAI, and probably Stripe, Discord, and a dozen other companies you've never even heard of. Companies worth tens of billions of dollars. Companies you definitely can't buy yourself. You know what's wild? Right now, your 401k is making private equity investments that require a net worth of at least $1 million to access. But you get locked out. You can't touch these deals directly. The gatekeepers say you're not sophisticated enough, not wealthy enough. But your retirement money? Oh, that's sophisticated enough for them to use. This is the quiet scam hiding in plain sight in your retirement account. And by the end of this video, you're going to understand exactly how Wall Street created a two-tier investment system where your money plays by different rules than you do. Let's start with the obvious question. How is this even possible? When you contribute to your 401k, you're not picking individual stocks most of the time. You're picking funds. Target date funds, index funds, maybe some actively managed mutual funds if you're feeling spicy. These funds hold thousands of positions. You see the big names on the fact sheet? Apple, Microsoft, Amazon. Makes sense. But buried in the holdings of these funds, especially target date funds from the big players like Fidelity and Vanguard, you'll find something called collective investment trusts. These are pooled investment vehicles that regular people can't access. They're not registered with the SEC like mutual funds. They're basically private investment clubs that only exist inside retirement plans. And inside these collective investment trusts, private equity stakes, venture capital positions, pre-IPO shares of companies that won't be public for years, if ever. Fidelity has been doing this since 2018. Their Freedom Funds, the target date funds that manage over $900 billion in retirement assets, started adding private equity exposure. Vanguard followed. BlackRock followed. Now it's standard. The pitch sounds reasonable on the surface. Private companies stay private longer now. In 1996, companies went public after 4 years on average. Today, it's over 10 years. Some never go public at all. Stripe is 13 years old. SpaceX is 22. The explosive growth phase that used to happen in public markets where anyone could participate, that all happens in private now. So, the fund managers tell you they're doing you a favor, giving you access to returns you couldn't get otherwise, helping you diversify beyond public markets. Here's what they don't tell you. First, you're paying for access you already can't have. The expense ratios on these funds don't break down how much of your fee goes to managing private positions versus public ones. But private equity fees are famously expensive. The classic model is 2 and 20. 2% of assets annually plus 20% of profits. Your index fund charges you 0.04%. Your private equity exposure, probably 50 times that. But it's bundled in, so you'll never see the line item. Second, private equity is illiquid, meaning you can't sell it quickly. When you're 67 and you need to start taking required minimum distributions, the fund has to sell holdings to pay you. Public stocks? Easy. Sell them in milliseconds. Private equity stakes? They're locked up for years. The fund has to either find a buyer in a private secondary market, wait for an IPO that might never come, or sell at a discount. This creates a problem that nobody warns you about. In a market crash, when everyone tries to pull money out at once, funds with private holdings can't liquidate fast enough. So they have to sell the liquid stuff, the public stocks, at fire sale prices to meet redemptions. You end up subsidizing other people's exits while stuck holding illiquid private positions that might be overvalued anyway. Which brings us to problem 3. Valuation. Public stocks have a price every second the market is open. Private companies? They're worth whatever the last funding round said they're worth. And those funding rounds are often structured with special terms that don't apply to your fund's stake. Liquidation preferences, ratchets, down round protection. The venture capitalists who led the round get all these protections. Your retirement fund bought in later with none of them. So when the fact sheet says your fund owns SpaceX valued at $150 billion, what it really means is SpaceX's preferred shares last traded at a valuation implying $150 billion. Your fund probably owns common shares or a derivative position worth significantly less. But the fund values it at the preferred price anyway. This isn't theoretical. When the tech market corrected in 2022, public tech stocks fell 30, 40, 50%. Private valuations? Most funds barely marked them down. Fidelity eventually cut its SpaceX stake valuation by 11%, while public aerospace stocks got demolished. Either SpaceX was immune to gravity, or someone was being creative with their math. Now here's where it gets actually offensive. While your retirement fund is loading up on private equity, you personally are banned from investing in these same companies. The SEC says you're not an accredited investor unless you make $200,000 a year or have a net worth over $1 million excluding your house. The justification is protection. These investments are risky, complex. You might lose money. Better to keep you safe in your little public market playpen. But your retirement money? That's allowed in the deep end. Because once it's in a fund structure, suddenly it's sophisticated. Suddenly it's safe. The same regulators who say you're too dumb to buy SpaceX shares directly are perfectly fine with your 401k doing it for you, as long as Wall Street gets to charge fees on both sides. Let's be clear about what's happening here. There are two classes of investment opportunity in America. If you're wealthy, you get direct access to private deals. You get the terms venture capitalists get. You get to negotiate. You get transparency. If you're not wealthy, you get indirect access with worse terms. Higher fees, no transparency, and you find out what you own by reading a dense holdings report once a quarter. Your money is sophisticated. You are not. Remember that. So what's actually in your retirement account right now? If you have a target date fund, probably between 5 and 15% is in alternative investments. That's the catch-all term for private equity, venture capital, private credit, and other stuff that's not stocks and bonds. Fidelity's Freedom Funds had about 8% as of last year. Some of T. Rowe Price's target date funds are pushing 12. You might own pieces of Instacart through multiple funds. Probably some health tech companies you've never heard of. Definitely some private credit funds that are themselves lending to other private companies. It's turtles all the way down. And you have essentially zero control over any of it. You can't vote on whether your fund should add private equity. You can't opt out without moving your entire account. You definitely can't see the actual terms of the deals or the real-time valuations. The irony is delicious, by the way. The whole point of index funds was transparency and low costs. Now those same index fund companies are layering in opaque, high-cost private investments and calling it innovation. Here's what you actually need to do about this. 1. Check your holdings right now. Log into your 401k. Look at the funds you own. Read the prospectus. Search for terms like private equity, venture capital, alternative investments, or collective investment trust. If you see any of those, you're exposed. 2. Understand that some private equity exposure isn't automatically bad. The problem is the terms and the lack of control. If it's less than 5% of your total portfolio and you're decades from retirement, the illiquidity doesn't matter much. The potentially higher returns might be worth it. Emphasis on might. 3. If you're within 10 years of retirement, seriously consider funds with zero private equity exposure. You need liquidity. The last thing you want is to retire into a market downturn where your fund can't sell its positions to pay you without taking massive losses. 4. Look for funds that explicitly avoid alternatives. Vanguard's index funds that track standard indexes like the S&P 500 don't have this exposure. They can't. The index doesn't include private companies. If your plan offers a simple S&P 500 index fund or total market fund, that's pure public equity. 5. Ask your plan administrator what the actual expense ratio is on your private equity exposure. They probably won't give you a straight answer, but asking puts pressure on them. If enough people ask, maybe someone starts caring about disclosure. 6. Vote with your contributions if you can. Some 401k plans offer multiple target date fund families. If one has private equity and another doesn't, you're making a choice about fees and liquidity. 7. Remember that private equity's outperformance is massively overstated in the marketing materials. The best private equity funds beat public markets. The average ones don't, especially after fees. And your retirement fund isn't getting into the best funds. Those are reserved for endowments and sovereign wealth funds. You're getting the retail tier of private equity, which is like getting the gas station sushi of alternative investments. The bigger picture here is that retirement accounts have become the dumping ground for whatever Wall Street wants to sell. They're captive assets. You can't easily leave. You get tax penalties for withdrawing. So fund companies can experiment with your money in ways they'd never try with a regular brokerage account where you could leave tomorrow. And it's going to get worse. The Department of Labor has been loosening rules around alternatives in retirement accounts. More private equity is coming. More venture capital. Probably private real estate, private credit, maybe even crypto funds structured as collective investment trusts. All of it with the same pitch. We're giving you access to exclusive opportunities. All of it with the same reality. You're paying premium fees for illiquid positions with opaque valuations that you could never access directly because regulators decided you're not smart enough. Your 401k owns companies you can't invest in. Not because those companies don't want retail investors. Not because the investments are too complicated. But because a system was designed where your money is allowed to places you're not. Where Wall Street intermediates every transaction and charges rent on both sides. The game is rigged. It's just rigged in a really boring way that hides inside fund prospectuses and collective investment trusts. At least now you know what you own. That's more than most people can say. If this made you angry enough to actually check your retirement account, subscribe. We explain the financial system's quiet scams every week.